Good evening, everyone. Very warm welcome to all of you. I am Sanya Chavan, Manager Certifications and Engagements at FPSB India, and it is my pleasure to host today's exclusive webinar on the future of passive investing in India and career opportunities. So, passive investing has emerged as a strong force globally and is rapidly gaining momentum in India. With the growing demand for low-cost, transparent, and index-based solutions, it is reshaping how investors and professionals approach financial planning. Today's session will give us a deeper understanding of this evolving trend and, most importantly, the career avenues it opens for financial professionals, especially CFP practitioners. To guide us through this conversation, we have with us two esteemed speakers today, and it's a pleasure to have with us Mr. Anil Ghelani, CFA charter holder and Senior Vice President, Head of Passive Investments and Products at DSP Mutual Fund. Anil has been associated with the DSP Group since 2003 and brings with him a wealth of experience spanning portfolio management, risk analysis, and investment product innovation. Currently, he manages a range of ETFs and index funds across asset classes and is a respected voice in India's passive investing landscape. And the other speaker here we have is our very own Dr. Alok Kumar, CFP professional and head of certification and engagements at FPSB India. With a PhD in management and over 2 decades of experience, Dr. Kumar has closely witnessed and led the evolution of the CFP certification in India. His unique perspective combines both industry insights and the academic rigor required to shape the next generation of financial planning professionals. So without further ado, let's dive into this session now. And I would like to hand it over to Mr. Alok, sir, to start with our discussion today. Over to you, Alok, sir.
Thank you, Sanya, for your kind introduction. Good afternoon, Anil, and
Hi, good afternoon, Alok and Sanya. Great to be here with you today.
Thank you. Yeah, same here. Pleasure is ours. And a very warm welcome to all my friends who have joined us today in this interesting webinar. It's an absolute honor, sir, and privilege to have you, Anil. And based on your immense learning and the experience in the field of personal finance, I'm sure the audience is keenly looking forward to the great insights which are coming from your side. So as we all know, the topic of today's webinar is all about future of passive investing in India and the career opportunities it brings for the CFP professionals in this space going forward. So having said that, may I now set the context for this webinar. In fact, passive investing has always been, kind of, if I may say so, dismissed as average returns for average investors. No? And the clients, they want the best fund manager, somebody who can beat the market. So as CFP professionals, we do understand what is active and what is passive investing. But I guess the audience would like to have more insights from you, Anil, on what is passive investing all about to begin with, to set the ball rolling for this webinar today. So over to you, Anil, with this.
Sure, great. Thanks a lot, Alokji, for setting the context. And good evening, good afternoon, or good morning, depending on if you are watching this live or maybe you are watching this subsequently as a post-recorded session. Wish you a very warm welcome to this excellent session and great initiative by FPSB to get everybody together. Today, what I'm going to do is just set the context and dive into a detailed overview about why we feel passive investments such as like ETFs and index funds, they are soon, in my opinion, going to be the future of the way in which investment takes place in our capital markets. Why we feel that if there is a potential for a large growth coming across in this segment, then how people like you and me who are in the career or in the financial services profession can think of aligning ourselves with this particular growing trend in the markets. So friends, what I will do is that I have a small deck as a placeholder for our discussion, but like all discussions, we'll try to keep it very engaging, very open and free flowing for discussion. So as we speak right now, if you just see at the bottom of your screen, you will see a Q&A button. Please feel free to keep posting anything that comes to mind. It can be a question, suggestion, input, some experience that you have shared. अरे अनिल, आप क्या बोल रहे हो सर? मैं तो ये अभी एक क्लाइंट को मिल के आया और वो मैडम मुझे क्या बोल रहे थे, आप समझो ये ऐसा रियलिटी में ऐसा हम क्लाइंट को फेस करते हैं. Any questions, comments, experiences, please keep sharing at the bottom of the screen in the question answer window. And gradually, as and when we get relevant questions, Alok sir and myself, we will keep engaging and picking them up for further deliberation, discussion, and responses. Okay, so let's get started. And friends, just one quick thing. While of course, in today's world, everything is so easily accessible, and thanks to technology, we are connected digitally, but nothing can take away the comfort of connecting in person, where you can get the feedback of the opposite side. So in case even during the session there is no question, but just some input, something is not going fine, or go slow, go fast, or even if everything is going fine, just type something in the chat, the Q&A window, say okay, yes, fine. So at least you will also feel engaged. Okay, something is going on. Otherwise, sometimes we will end up being in a situation whereby we are listening to something, but we are not able to grasp it. Great. So I'm just going to quickly switch to presentation mode and share the screen. Like I said, this is just a placeholder. I've captured few big data points. Some of it you might have already seen. You are practitioners, you are sharp professionals in our industry. Some of you, I can't right now see the names, but some of you who are part of the CFP and FPSB community, I know as a fact, are very senior and seasoned professionals, but still sometimes putting data in different context and sharing and exchanging views can be engaging. So I've just tried to do that over here. My first slide, friends, is slightly important, but not very relevant. It is from my side as an individual, like certain risk factors and certain disclaimers we have to put up front. So I've just captured it over there. This is just for my purpose, educational purpose, not anything to do with any sales or any mutual fund distribution related activity. Okay, so just to get started with the lighter side, I just captured this. Sometimes, we say that like, okay, whenever we are looking at investing, and like how we just spoke, and that Alok also mentioned that sometimes client wants something engaging, exciting, something to do, with tracking some trends and some star manager deciding what to do in terms of the allocation, which is wonderful, which is great. And hence, like, that when we start with the ABC of investing, the A comes up front for active funds, basically, and then we come with B, and that sounds like, okay, boring, basically, when I talk about passive funds, B for boring is something which comes at top of mind. But sometimes in certain context, maybe the boring can also be good from your client's perspective. So we'll little bit discuss about that in more detail gradually. Now, if you look at it, friends, just on the lighter side, again, I just shared this particular animated characters. I mean, from a very popular movie. Many of you might be already familiar with that. Some of you who are like very young professionals, maybe if you have not watched this, or if you have seen it, just feel free like to make it engaging and just type in the question window. So this is like a very popular movie called the Kung Fu Panda, and the panda is the main center of attraction and the hero, and this bird is the so-called father of that panda and very famous cook. And he says that I make this very nice soup, and it's very famous because I add some secret sauce. I have some secret ingredient in it, which makes it very popular. Wow, wonderful. Everybody's in love with that soup. Similarly, in active management, what we do is that there is a secret sauce, there is a secret ingredient, and that ingredient is the analyst or the fund manager or the star manager, or a team of fund managers and analysts who bring in their secret sauce in terms of the research inputs, in terms of the way in which they are making the judgment of the capital markets and the drivers of risk and returns. And they are trying to select some stocks, some sectors, which will be in a position to outperform the broader market, right? So that's a classic form of active investing, whereby we are trying to understand the capital markets, the drivers, try to go overweight, underweight certain stocks and sectors using our secret ingredient, the research inputs or the judgment, and trying to outperform, right? Everybody with me? Okay. Now, as we move ahead in that movie also, gradually what it comes to light is that yaar, वो तो कोई ऐसे secret ingredient था ही नहीं, मतलब it was just that soup, and which gradually became famous and powerful, but that narrative created around it continued. Sometimes it worked, sometimes it doesn't. So it's like that. Similarly, in active investing, when you are taking a call and trying to outperform the benchmark, yes, sometimes it will definitely do, sometimes it will not. So gradually, this got evolved that let us come up with a solution whereby there is no such human judgment or secret sauce or the way in which a team or a fund manager or analyst will decide on which stocks to pick or which to avoid. Instead of that, let's have a rule-based approach. Let's have a broad market whereby we will aim to perform in line with the market. Means instead of trying to beat the market, we'll just try to mirror the market and give you risk and return similar to what the market is doing. So in that movie also subsequently it came to light that it's just the hard work and effort, and that gradually made the panda became the successful hero and the dragon warrior, basically, or something of that context, just to set our discussion, like the key difference between active and passive. Of course, there are a lot of other scholarly definitions and data, but I just wanted to highlight and flag off with this context. Now with this, let's quickly take some data points and see how the passive industry landscape is looking like. So we'll just make one comparison between what we are seeing here in India and what we have seen in like some of the developed markets like the US as an example. Now, friends, in the US, sometimes, I mean, I don't always agree, but sometimes the loosely speaking narrative is that whatever takes place in the US, after a decade or so, like, gradually India and other developing countries also follow in that. Nothing like that. But yeah, just as a context, keeping it in mind, if we see the asset management or the mutual fund industry in the US, about a decade ago, means in 2013-14, it was the first time when little bit passive funds started being spoken about. At that point of time, 2013, I think, was the first year when passive funds saw slightly higher net inflows as compared to active funds. It was a good talking point that, okay, now, things are looking like that. Passive funds are seeing a little bit higher flows. Okay, wonderful. Active funds also were seeing flows. And this is the block of AUM, still around 73% of the total size of the US mutual fund industry was in active funds. But gradually, over the next decade, as you see, the way in which the passive funds gradually started growing, it crossed being about 1/3 over here somewhere, and gradually over here, it became more than half, slightly above 50%. Here it became 53%, 54% currently. So it has gradually started picking up. And now, in fact, the ETF and index funds or the passive funds are more than 50% of the entire US mutual fund industry. Again, very well-known data, nothing to that. But this context I'm sharing, that in 2013, means about a decade, little bit more beyond, was the first year when, in fact, it was gradually turning somewhat where we see India today. And that was the first year when active funds flow slightly higher net inflow as compared to passive funds. Both saw net inflows. But more recently, in the past couple of years, in fact, it is that only passive funds are seeing net inflows, active funds are seeing net outflows, friends. So just to set that context, and like even in India, how we are seeing this evolution moving. So if you see the way in which our AUM have been growing, most current data points suggest around 16 to 17% of the total mutual fund industry is now comprising of the ETFs and index funds. In that context, where we feel that the money is coming, predominantly we are getting allocations in large cap, in Nifty and Sensex type products. Predominantly, we are seeing some allocation coming through in commodities, etc. But still, it is like large portion of our block of money is in actively managed funds. So maybe what we saw in 2023 today, whereby mutual fund industry in India is gradually growing, coming around 17% of the total, and what we saw in the US, let's say in 2013, and then what happened in the next one decade. I'm not saying that it's something which we'll immediately start seeing back here as well, but definitely something which I would feel will be in terms of important aspect to keep in mind as we move forward in the industry over here. So just wanted to highlight this aspect and then take one more deep dive in terms of some actual data points, because friends, what happens very often when we as wealth practitioners or when we as financial planners approach your clients, or we are talking to our large families who are our clients, or let's say some individuals, young professionals who started earning their salary, so we feel that नहीं नहीं ये मेरे क्लाइंट के लिए तो ये रेलेवेंट नहीं है. Anil and like Dr. Alok ji, ये हम समझ रहे हैं index funds, ETFs are growing, but sir, you don't know this is more institutional side, EPFO वगैरह, government mandate वगैरह, retail and all, it's not really very relevant. But friends, again, some very hard-hitting data, public available information from AMFI, which indicates that how today the retail and HNI, which is a large component of a lot of the clientele, their AUM has been increasing manifold. So friends, in 2020, March 2020, just before the pandemic crisis and all, if you see the total index funds AUM, we had approximately 5,000 crore total in HNIs and retail, and total approximately 5,50,000 folios, number of folios, and now that has increased manifold. That size, the AUM of retail and HNI put together is close to about 1,75,000. Number of folios, just take a look, friends. 5 lakh folios have gone up to 1 crore 27 lakh folios, means approximately 86% CAGR growth in just number of folios. So just think of it, how many number of clients are aligning this side. Likewise, for the ETFs, large component of the AUM, no doubt, is in the corporates, which is what like the government administered EPFO, some of the large institutional players. So as a percentage of AUM, no doubt still it is large over there. But still over there, if you see number of corporates also, only 21,000 corporates, it has grown to more than 1 lakh corporates now. And in terms of HNI and retail, just look at the size basically, 7,500 growing to 75,000, 4,000 growing to 14,800, and number of folios from 18 lakh has grown to 1 crore 92 lakhs. So friends, just I'm trying to highlight that it's no longer that it's purely institutional driven. It's no longer it's something which few large government administered allocations are coming through. It is also retail, it is also HNI. In big way, they are adopting. A large part of this is due to technology and the way in which today it's so easy. You can just do a left swipe or right swipe on your fancy mobile app and you are able to open a demat account and start investing into an ETF. So it has been observed that in these past 4 to 5 years, more so after technology and account opening and all have become more simplified, we are seeing this kind of a rapid growth in the passive investments across ETFs and index funds in our domestic side as well. So I just wanted to take a small pause over here at this I can see a few comments, etc. And also just take a one small break to check any questions. Anybody can, everybody is able to hear and see me properly. Many new friends are joining, so welcome. And please use the Q&A window, not the chat window. In the Q&A, you can type freely whatever you want, and people will be able to post their questions and comments and feedback.
Thank you. Thank you so much, Anilji, for those initial few slides and that beautiful story of Kung Fu Panda. I just want to quickly check with you. So this adoption of passive funds, is it only by direct investors or even the mutual fund distributors, and regular plans are seeing growth? So what kind of trend is visible there?
That's a very, very good question, Alokji. I think that I have some data points around that also. I'll just share it in a minute. So, Alokji, I feel, and friends, I think this is a great question, that is it only few direct investors, DIY type investors, who are very well informed investors and who want to, let's say, take their tactical view? Is it that they are the main drivers of this growth? Well, I don't think so. It's a broad adoption gradually. Maybe if this same session we were having not today in 2025, but in 2020, possibly I would say so. Like I remember early in the period when, like, my engagement with the ETF and index fund industry started. It was 2009 2010 period. At that time, hardly anybody were even aware of, like, how ETF works or what type of nuances would come. But now today, I think it's very prevalent across. So I'll just once again quickly go back to sharing one more data and chart. Yeah. So friends, this is a data point of how the entire block of AUM of the equity index funds is broken down into the two components, that is a direct plan and the regular plan, right? So very, very simple and very logical data. In 2022 June, this was the breakup of direct and regular. Around 55,000 was in the blue shade, that is a direct plan, and 17,000 was in the regular plan. It's small component. I mean, even graphically, you can see the orange bar, which is the regular plan, very small. And over the next 3 years, the CAGR growth in the regular plans we saw was around 65%, which jumped from 17,000 to 78,000 crore. And even in terms of the proportion, like you can just make out pictorially that it is gradually, the red shade is increasing. And today we have approximately 24%, or like you can say, approximately 1/4 of the entire pool of money is coming from regular plans, friends. Regular plans, distributor or MFD led play for the equity index funds has been increasing very slowly and steadily over the past 5-7 years, taking it today to around 25% of the total share of AUM for the equity index funds side. So I feel that, most certainly it is a indicator whereby we feel not just some corporates, not just some DIY investors, but also a large component of distributor led, large component of play in terms of the advisors are shifting to this particular segment of the markets.
Yeah,
so I'll continue maybe, and as in when other questions come up, we can keep moving into that. Friends, I request you, I urge you, please keep posting questions. It will be more fun and very engaging. And once again, welcome to many of the friends who are joining in last couple of minutes. I encourage you to keep posting your comments, suggestions, questions.
So Anil, we have received a couple of questions. I don't know if this is the right time to just bring them to your attention. One is about what is your view on momentum index funds? So that is one question which we have parked. And then there is another question which says, with direct and passive around, whether relationship managers or IFAs will be relevant after 5 years. So these are, a couple of questions which have come in the chat box. Please feel free to,
sure. No,
respond to them at your, convenience.
Done. I think some of them I've tried to capture it as we move forward. In the next 5-7 minutes, we'll come to that. But otherwise, we'll specifically jump back into that specific point. So thanks a lot, Anupam, who has raised this, and Lakshmi Narayan. We'll definitely jump into that very shortly. So now I'll just take a small live type of example, with of course a very random story. Basically, let's say, we are advising some of our clients, and like, classic form of financial planning. I mean, so let's say, just for the namesake, this small family is our client. Basically, this is, let's say, a dentist, and her husband and two kids. I mean, why she is a dentist, I don't know. I just like that because all four of them are smiling and white teeth. So I just made her up as a dentist. So she is a dentist, and the gentleman is also some doctor, and like, they have a successful practice, and they have two very bright and smiley kids. Now, structurally, what are their key financial needs? Basically, okay, first and foremost, okay, two kids, maybe I have to broadly start planning for the education gradually. Maybe I need to buy a new bigger clinic slightly, basically, and a little bit further long term, focus on my comfortable retirement. Now, how to fit or position passive investments? And this will also bring to the one question which was raised some time back, that from Lakshmi Narayanji, that if direct investing is there, like, what will the RM or relationship person, or we as a financial planner, or like, what will our role be? I mean, so friends, it is not that people will just like that click a button and do it. That will be the worst outcome. Hence, I give example, okay, this is a dentist family. Their expertise is not really into capital markets or understanding business cycles or tracking what madam has announced in terms of reforms to the tax regime recently. So what their objective is, that I need to be the best dentist. So when Mr. Alok or Mr. X or Sanya madam come to me, I will give them the best service and the best latest treatment. I am not having time and energy to focus on capital markets or finances. You please be there and help me with whatever you want, passive funds, active funds, combination of the both. So maybe for such kind of investors, some component maybe of a core allocation can go into a long-term allocation, which will build a equity corpus. Some component which can be allocated to adding on as a kind of a allocation towards a strategic or tactical call. Let's say you as an advisor, as a planner, you feel, okay, now the GST reforms have come. Maybe it will give a big boost to consumption as a theme within that, let's say auto, paints, etc., etc. So let me take an overweight position in that theme by maybe adding some actively managed funds or some AIF or some PMS, whatever it might be. But I, as their financial planner, as their trusted advisor, will retain my coverage of them, give them the relevant inputs. At that point of time, the doctor family does not need to know, okay, which fund manager is shooting the lights out and performing very well or something like that. But they just want to ensure, okay, their respective financial needs are being thought through by you, and you are helping them to achieve that. So it should be for such kind of a financial planning, okay, their plan of their life goal and how we can align the financial plans with those life goals. So investing for them should be not much about beating the market. Okay, last year broad market gave 0 return, but look, my portfolio gave 5% return. Fine, no problem. You beat the market, that's wonderful. But for them also, it's important how to meet the market and try to achieve their goals, basically. So that's just some context I wanted to share, that how and in what context we can consider this kind of passive funds to be incorporated, to be used in conjunction as a complementary to what we are seeing in terms of the like, how should I say, the overall use case of the index funds and ETFs, basically. So it's not that after ETFs and index funds will come and direct plans are growing, so our role will diminish, or why will client need us? Certainly they will need. At such points of time, the advice is most important, and at the same time, this is how the context would work, I believe. And I think on that couple of other points also have come from KU as well, from a couple of other people. So thanks, and it's a great question. So I just wanted to flag off this point as well, And while on that, I mean, one more thing which often comes as a question, and like how we see the growth of this coming through, like in terms of whether we see that, is this going to be driven, or the growth will be coming from so-called tech platforms, or so-called areas which DIY type investors do. So I strongly feel it will be a combination of both. Some of these DIY type platforms, of course, will be making it simple, making it, like, how should I say, democratized and easy to access. But other than that, large component will still remain to be guided investments. Like friends, I often give this example, that all of us who are into financial planning, into mutual fund distribution, advisory, like the dentist family, we often become a family advisor. So we don't advise only one person or 2%, but the entire family consults us or trusts us in some other way. So very often what happens that next generation of the family, young professionals, started doing their job. Nowadays, everybody gets their first initial salaries and they want to, have disposable income and start investing. So very high probability that whichever company they've started working, they will offer them some, salary account. They will come and showcase them some fancy mobile app that just press this left swipe or right swipe, and some investment from your salary will go and get parked in something, That also, friends, is the biggest risk, because then they will never be able to control or cover the overall family type of a relationship in terms of risks and where they could face issues. So these are in fact good opportunities for you also to go to the clients and their family, the younger family members also, that look, I know you and your family since you were a child. Now that you have started earning your salaries also, don't just blindly go and DIY type approach. Remain under my consultation and my purview. I know how best your family reacts to events, to risks. I know where allocation should be done. Still, I will give you good combination. Some passive funds, overall it will reduce your comfort and cost. Some active funds, strategically, and on a broader portfolio level, I will keep guiding you from time to time. So it can be in fact good tools which can be utilized. One more thing just came to mind, sir, Alokji. I don't know if hence sometimes it's more fun if we are live in front of the people and people can answer. So friends, even if I know everybody can't see each other's answer, but if you can just use the chat window and type back where most of us are located, means I know it's somebody once been in Mumbai, some in Bangalore or in Kanpur or wherever. Just type through which city you are based out of. Very keen to know. So for example, I am based out of Mumbai. Maybe a couple of people are in Mumbai. So in Mumbai, there is a very famous train station. And whenever you pass by that train station, you get a very beautiful, very nice fragrance, It's a fragrance of a biscuit, which is getting manufactured at a factory behind, So like, if you can relate to it, it's like the, Parle G biscuit, the very, very popular, very like, how should I say, cult following. Everybody must, whichever part of the country you are in, means you must have eaten Parle G biscuit, I'm sure, or even you are not even in India, you are based in Singapore, or you are based in Sydney, basically. I'm sure, if you have some roots in India, you must have been familiar with that. Now, friends, just look at the Parle G. From so many generations, so many years, it has maintained the cost and consistency. Ek Parle G biscuit, you will get it at that particular price point from such a long time. Similar consistency in terms of the quality and the taste. So, in certain way, like whenever I'm out for meetings, and I also often go for sales meeting with team. In my bag, I always have one Parle G packet, By chance कभी late हो गए घर पे पहुंचते वक्त चाय मिल गई कहीं but एक छोटा सा Parle G dip करके खा लिया तो ऐसा थोड़ा मजा आता है, basically. It's a part of my complementary toolkit whenever I'm moving around. Likewise, if you are moving around with maybe with like young kids in the family or something, you will always want to add this on. Maybe in today's world, I have the fanciest of the protein bar also with you, but most of us will have that also, So I just wanted to highlight that cost and consistency, like a Parle-G, ETF or index fund also can be a very useful integral part of your toolkit, basically. That is what I just wanted to put it in context. Thanks for answering. Somebody is from Netherlands, somebody is from Dubai. So nice. And I'm sure even though you are currently based in Dubai, Padmashri ji, or Ujwal ji, you are in Netherlands. So nice to hear that. Somewhere or the other, Parle-G must be available in your city as well, and I'm sure you might be at some point enjoying.
It's synonymous with tea. Anil, it is synonymous with tea here in India.
Yes,
Yeah.
exactly. Yes. So like, I mean, Haji sir.
Anil, I just wanted to pitch in here and check with you. I mean, so you are saying that passive investing is spread across and various because of various platforms. I mean, just now you gave an example of the dentist couple and all, and you're also saying that technology is helping people to take those investment decisions, and not only decisions, the actions of investment very quickly. So it is making them, so maybe they are not giving it enough thought, or not enough research, or maybe not enough of discussion or introspection or need analysis, I would say, simply because the technology is so much available to us today. So is that a kind of a, something not to have, or something to be used very judiciously with proper due diligence and all?
So I think you're, sorry if I may get it rephrased, like you're saying that is it that these kind of funds should be aligned with?
No, I am saying, you mentioned that all these purchase actions are available to us when we swipe, with our fancy mobiles, right?
Yeah.
So since it is available to us so easily, uh, do we understand that, as an investor, we are not giving due diligence, we are not doing proper research, we are not doing proper study, we are not taking the proper guidance or need analysis, risk analysis, and since it is available to us at so easily and so comfortably, so we are, simply going ahead and doing all those purchase transactions. So is this enabler a kind of a we should use this as an investor very cautiously? As a CFP professional, what should we guide to our clients?
Yeah. Great point, sir. No, I think that's a wonderful point, Alokji. And yeah, as a professional, it is our duty that irrespective of the ease or convenience of investing in anything, of course, we must always understand the depth and the drivers of risk and returns of that particular investment. So whether it's an active fund or a passive fund, buying with a like a ease and convenience or transparency, each of them will have a unique driver of risk and return, which could result in your investment journey to be either smooth or either wavy. And hence our duty as a finance professional is paramount to our investors. We own it to them that when they are buying anything and or we are adding anything for them in their portfolio, the clarity about how it's going to play out on an overall basis is very important. Like, for example, sir, recently there have been a lot of discussions and a lot of investment calls being given on silver as an asset class. Just example I'm saying. Now, no doubt, silver as an asset class is very good for an investment. Silver has a good diversification quality of as a like a low correlation with equity and fixed income. It has got certain good fundamental drivers. So many people are saying buy silver. But maybe for certain components of certain investors' portfolio, it might be very high volatility. Maybe they might not be able to absorb that volatility, or that time horizon might be different. Maybe one of the life goals of this dentist family was to buy a new clinic in the next 3 years, for which they had planned X number. In that, if we park some allocation into something which is very volatile, and in that time, let's say it's a long super cycle of commodities and it's going down, it doesn't suit well. So I think, yes, our duty as finance professionals, our duty as many of the friends who are very sharp CFP professionals and focusing on their, clients in a very prudent way. Most certainly, it is important to decipher that, and only then offer it as a part of the client's portfolio, basically. So that, yeah, I completely agree. That's a great question.
Sure, thanks. Thanks, Anil.
And in some way, that leads me to one more important chart and slide I'll just quickly share. Like when we talk about, the passive investing, and one or two questions also have come up that, like, so if this happens, will everything else get done with, or, should I, replace this by active funds? Well, most certainly not. Passive funds will be a very beautiful complementary strategy. So if we can think of it as like a core and satellite allocation, then I believe it can work excellent. So some part of the allocation to your client's portfolio as a core allocation, if you're doing, which can just give you market exposure, no human bias, relatively low cost, so it helps overall clients portfolio to go down in terms of the cost. That can be considered along with a actively managed satellite allocation. So, it's something which definitely we should be thinking of more as a complementary strategy. अपन बोलते हैं ना sir, on the lighter side के, while making any decision, whether investment decision or any decision in life, जैसे आपने कहा कि, like, when you're having the tea, like tea and parle G is synonymous. But I would say कि सर, अगर आपको choice दिया है कि okay, I'll give you parle G and also I will give you बड मस्का basically, तो आप बोलेंगे ने, why should, दोनों रख दो ना अनिल भाई, मिल रहे हैं चाय पीने के लिए, दोनों रखना साथ में. So it's like that. No, why I should choose, Parle G or Bud Muska? If I have the power of and in all decision making, it's always more useful. So I feel that way, as a complementary strategy, if we use it, it will be more relevant, more powerful. That is how we should consider using it, basically. That is what my point would be.
So Anilji, if I can come back to you with my another set of questions. So how can financial advisors, how can they use passive investments like index funds and ETFs? How can they use these investments for their clients? And as you said that it is not a replacement of active, so it should be used both Parle G and Banmasta. So it is not a replacement of active funds. That is clear. So, but how can financial planners they use these passive investments?
So I think the best is to use it like this as a core and satellite allocation. In some core allocation, use your, let's say, equity as an asset class to add something as a kind of, let's say, if you are thinking of that particular same example of a family, and young members of the family have recently started getting the salary, and we know that they have a very long horizon because family supported spending is going to happen, then maybe park large component of that in the low cost passive fund, because over a very long cycle, whichever active fund we select, there is a very high chance that that active fund can go or will go through cycles of outperformance and underperformance. So often the gap of the or the divergence between the fund returns will be so high that it becomes very difficult to have the client responses or the client discussions. And what to explain that time, madam, this fund we have selected, but it is not doing well because fund manager had been overweight on auto as a sector, and auto is not doing well because of the sentiment. Now that client is a dentist, sir. They are not understanding what is happening in the GST regime, and hence auto or whatever I'm saying, blah blah. Instead of that, if you just give core allocation, low cost, let's say index fund, very easily you can relate to that and close that chapter and focus on the other part of okay, now your financial planning with the next goal of the child's education. Now first goal of buying new clinic we have almost reached. We are redeeming some money, take this your 50 lakhs or your X amount, go out buy your clinic. But now we have to now push hard for the next goal of child education. We need another 12 years left. Example I'm saying. So the discussion can focus on that part. But divergence, I think, and that brings me to another point. I'll just share my slide again. One of the key reason I feel for the growth of passive funds is this. Very interesting and hard-hitting data points, friends. If we see the entire range of large cap active funds and we see the divergence, let's say 1 year performance, okay, it's a short period, But still, if you see 1 year performance, this is like one fund, the worst fund has given negative, best fund has given approximately 25% return. But let's say we go very long period, 5 years, 7 years, or let's say we go 10 years period, and just look at the data points, how it looks at, like the gap between the worst fund and the best fund is approximately 3 to 4% CAGR. Somewhere in between, we'll see our index fund like Nifty 50, Nifty Next 50, वगैरह. So if, let's say, no doubt we have the good grip of analyzing funds, analyzing active managers, and maybe we'll select the best fund only for our clients, but still they will have cycles. So suppose if the fund which is doing very good in today's cycle, which has delivered this green color shade this year, but after 10 years it happens to be, let's say, this fund, then client would have lost such a large component of the potential for return generation, versus if I just select the average and give that particular core allocation, client is always going to be a little bit more protected. So some part of this divergence in performance also is a big driver and the rationale for growth in terms of the way we feel passive investments will grow in the future, basically. So what I mean is that today, if I were to see data world over, today the total professionally managed assets is around 125 trillion, out of which around 15% is ETF and index funds. Now in India, about 73 lakh, 74 lakh crore size, around 900 billion in dollar terms. So just put it in context of the 125. So very small yet we are in terms of total size of AUM, what we see globally. Within that, around 12 lakh crores is around 16% is passive funds. From equity AUM, we have crossed a little bit more, we are 21%. And what I feel is that with these few drivers, like the divergence in performance that we saw, the simplicity, the way in which the cost is there, we feel that we could grow to around 30% in terms of the way our total passive funds will be based, will be positioned in India, basically. So this divergence, Alokji, is something which I think is very important element of our guidance and advice to investors also, and hence that also becomes one of the key factor for the growth, basically.
Awesome. Yeah, cool. So taking a cue from there, Anilji, so what are the kind of investors, what is the profile of those investors, what are those investor profiles to whom financial planners should suggest or recommend these passive funds, although it can be a small component of their overall kitty, of their overall investment, but still, is there any suggested kind of a investor profile to whom financial planners
great question.
should go forward and
yes. Great question. So see, this is a fundamental our learning of any financial planning and combination of financial planning and risk management, how we align life goal. This is how I like to see that. First think of the life goals of the client, then align different financial goals with those life goals. So in that, I feel it can be very useful for, let's say, early investors, first time investors, who are new to investing, who want to just start accessing the equity markets. So I'll just take a pause and give one example over there. Like and I know we have people from many cities, so I'll give example of one city which I had been to a couple of years back. It was in Indore, and near to Indore there is a Pithampura, is like an industrial area. So a team, usually whenever we are traveling, sales team on ground takes us for meetings. He said, sir, I'll take you for various meetings through the day. One of the meeting was with a large tire manufacturing company based out of there. So usually what happens, my meeting is with like the treasury head or corporate office and all that. I said, चलो भाई जहाँ भी लेके जा रहे हो, साथ रास्ते में वो 56 गली रुकना भाई, नाश्ता करेंगे, चाय वाय पी के जाएंगे, मस्त है ना. तो हम लोग पहुंचे उधर. So this time meeting was not with that treasury head or finance person, but with the factory workers. Suddenly I was in front of a like huge space of 500 people, and I have to just give a discussion. Now what to tell, how to discuss okay, if suppose, for example, they would have been investors that, okay, this fund has been doing well because, same example, I was overweight in auto and it didn't do well, but I was underweight in, let's say, metals and they have been having a good rally. So instead of that, like I said, first time investors, relatively new to market, these kind of simple, easy to understand passive index fund could be best. So in that situation, suppose if I were to just say, okay, you had invested into my Nifty index fund, you see broad newspaper or whatever, which last 1 year. This is not actual data of last 1 year. Last 1 year Nifty has been broadly flattish, but just for example, let's say we say Nifty has given, let's say, 8% return, 10% return, and your fund has given 9.75 or 9 point, like something like that. Okay, so that you can relate to it. Now put that aside and let's start discussing about other areas. That, are you thinking of some SIP top up, or, oh, by the way, are you also protected by some life cover? Let's focus on those financial habits, etc., etc. So first time investors, new investors who want to get started. Second, it can be very useful for people or investors who want to be cost conscious, but retain our guidance and advice. So, okay, I'll give you direct access to these kind of products at regular plan also, but which is lower than cost wise other products. So cost conscious people, definitely it can be useful addition in some way. Third, it can be very useful for people who are looking for a diversified equity exposure. अपन देखें ना, वो न्यू जनरेशन है, उसको एक डाइवर्सिफाइड इक्विटी देना है भाई लॉन्ग टर्म के लिए, 25 साल बाद देखेंगे वो, तो बेटर टू पार्क देम ओवर देयर. और some very seasoned investor, who want to add it as a core allocation, or some very tactical call, like we are discussing, oh, right now I feel equity market has not done anything, but within that, large cap universe is doing even worse. So maybe let me buy a slice of only very large cap, very mega cap stocks, let's say only 10 stocks of the industry, and hold it for next 6 months. When it gives a spike up, then I'll exit. So for those type of seasoned investor also, it can be very useful.
Yeah. So Anilji, here, if I see the Q&A, I have a question from one of our friends, Mr. Girish Kapoor from Mumbai. So he would like to know, what can be those factors which lead people to switch from active funds to passive funds, For example, like the current ongoing tariff war. So is it judicious for people to allocate some portion towards passive? I don't know. I mean, this is some kind of advice which is seeking by here. But coming back to the core subject, which is like, what could be those factors which lead people to switch from active funds to passive funds, or maybe put a small component of their active towards passive? Do you have any thoughts on that?
Sure. Got it, sir. No, and Girishji, great point. And like, I mean, we will avoid, of course, specific advice type thing, but broad context, if I may put it that way, that in certain situations whereby there is a lot of uncertainty in the market, in certain situation whereby there is a what we call in very technical parlance, cross-sectional volatility. If the cross-sectional volatility in the market is very high, in such times, active funds have a potential to do very well. Whenever in periods when cross-sectional volatility becomes narrow, that time, even if the active manager has selected the best stocks and avoided the worst ones, the volatility between the two is so narrow that it's very difficult to outperform the benchmark. So whenever there is a divergence in the returns, or the dispersion between returns is very high, then you are better off going with active managers. So in periods when 2000 and like I would say 2021, like 2022, 3, 4, 24, it was like that way, whereby active fund managers were finding very difficult to outperform. So a lot of us also would be talking about it, in India in large cap now, active fund managers will never outperform, buy only index funds and all that. So I used to always tell people that don't say like that, because it's a cycle. Whenever then that cross-sectional volatility starts widening, we will get more and more opportunities for the active fund manager also. Within that wider range, select the best ones and avoid the worst, then you will get good performance. But if the range is very narrow, then even if you select the best one or the worst, it's very narrow range, you will not able to, very difficult to outperform. So that's how I would like to say see how the allocation would be done. to be very honest, it has nothing to do much with the current tariff wars or like, the uncertainty. During that time, in fact, it is prudent that within client allocations, wherever relevant, we should consider some hedge of the portfolio or some diversified exposure like commodities as a asset class. Very often what happens that many investors also don't like कि मैडम और सर कमोडिटी आप क्या बताओगे, मैं आपको बताता हूँ, मेरे पास 2 जनरेशन से गोल्ड बहुत पड़ा हुआ रहता है. Since last 5 years I have been buying sovereign gold bond. So it's our duty to clarify that gold you're buying maybe is jewelry buying or something like that. But in your investment portfolio also, this can be a good tool for returns enhancement sometimes, as well as returns diversification. Okay, you have a lot of gold, no problem. Come, I will meet you next week and I'll show you 3 reasons we will not buy gold, but only focus on silver as an asset class. For example, that is our art and our knowledge of each client, how to position to them. But I'm just saying, so in this uncertainty environment, we are facing 2 big wars. One is a real war on the ground, very unfortunate. I mean, we hope it gets subsided soon. And second is, since February onwards, the tariff war. So in both of these wars and uncertainty, I think it could be good times to add allocations to, let's say, commodity as an asset class, for example. That's how I would see. So it becomes like a kind of passive fund also getting added to the portfolio, but with a tilt or exposure towards a different asset class.
Awesome. Thank you. Thank you so much, Anilji. Yeah. So over to you, Anilji. Yeah.
Sure. Yeah. So no, I mean, great. And friends, keep the questions coming. I think the next point I would like to cover quickly is what we had spoken about. Like, okay, in the midst of a lot of these growth of the size of the segment, of the way in which we are seeing, investors moving over there. Is it something which I can focus on my career also? Like, will it help if I'm aware of this in a better way, or how I can align my career to focus on this aspect? So I just wanted to spend 5-10 minutes on that also, and very keen to get some questions. Of course, while discussing this, I'm bearing in mind we have a very mixed and diverse crowd. Some of you are very seasoned and senior professionals, but still just wanted to flag this off in a different context, and I hope you will find it useful. Friends, this is a very interesting way of focusing on our career or our practice or our profession. If we are running our own practice also, that at all points of time we should try and think about, ठीक है, आज जो चल रहा है मस्त हो रहा है अच्छे से, I am got a book of business, some clients I'm managing, etc., or I'm very young professional, just finished my studies, but let me think and position 10 years in future, 2035, how the world will be like, right? Because friends, whether we like it or not, there is a rapid change. In 10 years, world is going to be very different. Nobody knows what it will be exactly, but we can form some view or opinion, and then try to see who you want to be in that world in 2035. Let's say these are the type of dynamics or moving parts, or this is how our industry will be. In that, who I, as a person or as a professional, who I want to be, I as a Alok ji, I as a Mr. Girish ji, I as a Amit ji, I want to be in that world, and try to position that way that, okay, today I am sitting here and I have got now 10 years to align my business model or get in whatever I want, hire new people, do more, acquire relevant knowledge and skills for myself, build new relationships, what all I can do for that. So if I feel that in that 2035, passive investments are going to become big part of the ecosystem, like how we saw in the US, maybe 10 years later in India also, will we see the block of AUM, which today we are around 16%, will it cross 50% and passive? Just for example, how I can focus on that. And just as a lighter side, I just captured that, maybe, of course, many of us are already professionals with CFP designation, if not very important, such kind of professional qualifications or certifications would be very important. If we are already certified holders, then these kind of events and sessions for our continued professional learning or knowledge enhancement also are very, very crucial to form an opinion of what we do in our career. I feel very strongly we need to realign our thinking with this context, we need to plan ourselves and our business or our practice for 2035 and sharpen our skills, go for this kind of curriculum. Me, for example, I have evaluated recently CFP in more detail. I'm a CFA charter holder by background, and there also we learned a lot of depth of financial planning and wealth, but not with the depth or rigor that most of you guys have. So I'm keen to pursue, in fact, CFP, or maybe I'm looking at some other such program. Always we need to do that. Now, with that, many people who are also planning to be in jobs basically or not do their own profession. Very important how build out is going to happen. We have a huge potential for growth in the industry also. Just above, we saw some data points how today we have got the size of the total AUM, the wealth and asset management industry over the last 10 years has grown manifold. But in the next 10 years, we feel we are just at the start of the J curve and a huge growth is going to happen. So you can find lots of jobs, not just in wealth management, AMCs, but overall, there is a much more larger ecosystem, friends, when we look at wealth and asset management. We can do something linked to being part of the distribution community. We can be focusing on new developments. Suddenly in 10 years, something might change. RIA model can become very effective, very powerful. Maybe some kind of areas where large investors or family offices will need professionals and hire them, not just as a consultant externally, but even as jobs. Friends, 10 years back, I still remember 2015, we had got 30 only, 30 approximately, family offices, right? Most of you also who are senior professionals, you will relate to what I'm saying. Each of those, like you could count on your fingertips, or, we had a relationship manager mapped. Now there are around 300 family offices, of large HNI, UHNI families, and many more maybe in the, pipelines basically. So likewise, a lot of those large asset owners, who will need professionals to advise them, to mentor, to manage their money. So we need that kind of a entire ecosystem whereby hiring will happen, whereby we'll need professionals to, focus on their jobs. So I think that we're in a very sweet spot right now. Overall, within the financial markets, like we as a wealth and asset management professional, whether you are guiding investors to invest or you are managing their money, we are in the midst of a huge shift in the next 10 years, which we'll see not just for few individuals, but for the entire nation as a whole. As we move towards, like अपन बोलते ना, मतलब moving our move from here to Viksit Bharat will need a huge revolution, and we are all going to be part of it. Hence, huge potential for careers, for growth in the way in which we look at our markets and our clients' portfolios in a prudent way. So that's how, like, I would feel like the careers potential would be in future as well. And we need to focus on that and ensure right toolkits for us or our team members are created, basically,
Yeah, very, very aptly put, Anilji. I mean, lot of diverse and multiple career opportunities, I would say, um, in this field of personal finance, in the field of financial planning, and so on. I just also wanted you to quickly throw some light to our audience on this, factors like, there's some talk about smart beta and rule-based investing. So, in terms of, especially in terms of passive investment. So, what are these factors? What is smart beta, and what is your understanding? How much we as a financial planner should know and understand these things, and how we can, gain some knowledge on this, and then use it for the better investment for our clients.
Sure. Great point. Great point. So, friends, when we think of smart beta, I mean, whatever is not beta of the market or whatever is not the broad full market, in some way it's a angle of merging or blending active management with passive. So it's like a smart beta trying to outperform the broad market or the beta, So in simple terms, I'll just share a chart so I can explain in a better way. In simple terms, wherever, if we are able to give our clients slightly extra return, or we can give slightly lower risk with a better diversification. So in simple words, wherever I can give a return enhancement or risk reduction, if of course both is there, then wonderful. It's like the best of both worlds. But otherwise, either of these two with a little improved diversification, then that becomes a classic way of smart beta. It helps with cost saving and transparency and convenience as well. And friends, in general, when we think of smart beta, like what exactly is the driver, is the a way in which we think of the factors. Basically, when we talk about smart beta, and one or two questions earlier we had raised, how do you feel about momentum funds, etc. So this, what we say, momentum, growth, value, mean vol, these are all factors basically, which comprise of the formula or the thinking of how a smart beta should be positioned. So in very simple terms, Alokji, and again, like I'm giving example of Mumbai, but let's say take different example. We have a very popular marathon in Delhi. Basically, there's a Delhi marathon like we see in Mumbai also. So friends, when you are preparing for, let's say, Mumbai marathon or Delhi marathon, or somebody said you are based out of Dubai, I think Dubai also has a very popular something like that way. So at that time, we consult a dietitian and a fitness expert, right? And they'll say, okay, practice your fitness and start running, practicing. And that time, this is the diet you have to follow. Okay, itna protein intake should be little high, lower fat, higher fibers and carbohydrates. Sorry, I'm not dietitian, so pardon my ignorance if somebody is laughing here, Anil, kya bol ke ja rahe ho aap? But just like in that diet, then we dissect each and every food or water, I mean, beverage particle we have into its constituents. Like if I have had a meal of roti and chawal, then I'll say, okay, now my protein intake is less today. In the evening, we'll have a dal-based item, for example. So how we break down the food particles into constituents of its nutrients. Likewise, any asset or security or index can be broken down into the drivers of risk and return, which could either be value, momentum, volatility, quality, that way. So this actually is a very simple terminology, but often considered in a very complex way that, oh, this is something smart beta, or this is factor investing. Yes, but what are factors, or what are these various elements? They are nothing but the key drivers of risk and return of that particular security or asset class. Just like we can segregate or dissect our food particles into different components, like that we can do it for securities also. And then based on our view, if we feel quality as a factor has been underperforming since past couple of years, maybe in the current cycle, as we see flows coming back, quality will do well. Maybe if we feel size means small and mid cap have done very well, now they will turn around, maybe we'll reduce that. And if we feel that momentum is a good factor, let's go overweight momentum. Just example I'm saying. So then maybe we can combine momentum and quality, for example, and position in the client's portfolio. Or if we feel that at this point of time, we'll see a push and focus will be only on value, then we'll ignore growth, or we'll ignore momentum and focus only on value stocks. So in simple terms, when we talk about smart beta or factor investing, we should be able to implement that with small components into the client's portfolio, aligning it with our view of the markets, basically. So sometimes it's just jargon. Even we have some point called ABC, like in the momentum and value and min vol. Now, what will client understand? And hence the original question also, I think, which few of the fans had asked, भाई मुझे क्या करना है, मेरी जरूरत होगी कि नहीं? Will in this 2035 vision, will my profession as a financial advisor, as a planner, will it remain or will it die down? के बटन दबाओ, लेफ्ट स्वाइप कर दिया, खरीद लिया और बस बैठ जाओ ऐसा करके. Are we moving towards US like how robo advisors like Betterment and all have broken the entire market? I strongly believe not. Yes, some component will be enabled by technology, but the guidance, the advice, the alignment in the client portfolio, and the restructuring of portfolio from time to time will be paramount. Yes, there will be passive funds which will possibly take a bigger share of the total size right now. Maybe by 2030, we'll see 30%. That's what I've been saying. Maybe by 2035, which is our vision, it can grow from 30 to, let's say, 50%. I don't know exactly, but it will be very important piece of the client's portfolio.
Thank you. Thank you, Anilji. I think these are some of the very important points, actually. I guess the subject is so large, so big, so diverse, and so very interesting. See, putting it, summing it up in an hour or so is very, very difficult. But I think what we are seeing here is that we are seeing a clear behavioral shift, I would say. And investors, they are beginning to see that keeping the costs low, staying diversified, and sticking to discipline, I think. So all these things, they work better rather than chasing the next big idea. So, and with markets evolving continuously. So I think investing is today, it goes beyond simply buying the index. So we need to sum up all these learnings and then maybe come up with that kind of a near perfect solution for our client, and to see what best suit, how to align the goals with his investments, which you suggested, and maybe have a kind of a mix of active and passive into the portfolio. So thank you so much, Anilji, and thank you so much to our dear audience for listening to us so patiently. I'm sure we could not answer all the questions, but in case if you still feel that you have a pressing query, or if you have a very pertinent question, you can probably write to us on email to us, and we'll put it across to Anilji, and we'll try to get his response to as many questions as possible.
Yes,
Thank you
definitely,
so much.
definitely.
Yes.
Always available. Feel free. And like once again, like I said in the beginning, it's great for me. It was the first time I engaged with FPSB on an online platform. I think in the past 1 or 2 events I've been there, but it's very engaging, and the kind of participation that I found with the community is very powerful. So great learning for me also. Thanks for having me, and I'll try my best. There are a lot of questions I can see, some we covered, but others also definitely we'll try our best to respond.
Yes. Thank you so much. Over to you, Sanya.
Hello. Thank you for your kind words, Anilji. It is indeed a pleasure hosting you here. And thank you, Alok sir, for moderating the session for us. It was indeed some fantastic conversation here. And as we come to the close of today's session, one thing is very clear: passive investing is not just a passing trend, but a powerful transformation that is reshaping India's investment landscapes in the future. And for CFP professionals, this truly is an exciting time. By embracing these evolving solutions, you can not only provide clients with efficient and transparent strategies, but also unlock new career pathways in index-based portfolio management and beyond. So on behalf of FPSB India, I extend my heartfelt thanks to Mr. Ghelani and Mr. Kumar for sharing your invaluable perspectives with us today. And of course, a big thank you to each one of you in the attendance for taking the time to be with us. And I would like to inform you that those looking out for CPD points, the recording of the session will be made soon available on your learning portal. And additionally, the video will also be uploaded on our official YouTube channel for broader access by Monday. And before we sign out, I am delighted to share that nominations are now open for the upcoming FPSB India Awards 2025, which will be held in Hyderabad. And we encourage you all to visit our website and submit your nomination in the category that best reflects your achievements and contributions. And with that, we conclude this webinar and look forward to welcoming you again in the future. So until then, stay inspired, stay connected, and have a wonderful evening ahead. So thank you so much, everyone, for joining with us today.
Thank you. Thank you,
Okay,
Sanya.
thank
so much,
you.
sir.
The
Thank
award
you.
also seems very engaging and very nice to know about FPSB community. As I'm getting to know more and more, I'm feeling a FOMO or a left out situation that I'm not part of FPSB. Maybe like I must take it up as an initiative and pursue the CFP program soon.
It's never too late, Anil ji.
Yeah, you're
Yeah,
more
yeah,
than
yeah.
welcome, sir.
No, I always
Yeah.
feel like I
Yes.
shared earlier also, like, we need to constantly upskill ourselves, otherwise, like on my softboard, this is my desk behind. I have a, like, since many years, a photograph of a elderly gentleman in a suit, and he's riding a bicycle. So the caption below is like, our profession is like riding a bicycle. Either you keep moving or you fall down. So in fact, but right now I have been evaluating one other program, which is like a CMT, which is more technical chart analysis. But now I'm seriously considering and feeling left out. There is a good community. Like I know about CFP and FPSB since long time, but and observe many of the activities. But this is something very interesting and engaging. That awards and all also. I'll learn more about it. Maybe offline I'll connect with you, Sania madam, to get to know about the award functions.
Certainly,
How
sir.
it
And
works.
we
So
would be
thank you
happy
very
to
much.
see you there in Hyderabad in our next event.
Certainly. Okay, guys. Thank you very much. Bye. Have a
Thank
wonderful
you.
Thank you
evening.
all.
Happy
Thank you.
Friday. Bye bye.
Bye-bye.